The pound just crashed to its lowest level against the dollar in history. Only last year, £1 could buy you $1.40. Today, that same pound gets you $1.08. That's a 35% decline. And this doesn't just affect the exchange rates for your next holiday to the US. This is going to affect your mortgage, the cost of your energy, and the very stability of the UK as a country. If you thought the cost of living was already high and 10% inflation was bad, it's about to get a lot worse. There are a number of reasons why this is happening, and I'm going to take you through them step by step, so you know how they affect you and what you can do to protect yourself in the coming months. First things first, why is your money losing its value so quickly? To be fair, most currencies have seen steep declines against the dollar this year, though few as much as the pound. Since the dollar is the world's reserve currency, most global trade uses it. This constant demand helps keep it strong, even in times of general economic weakness. This is one of those times. As the world struggles with an energy price shock, supply shortages, and uncertainty about a global recession, the world's markets have been building reserves in the dollar, pushing up its price relative to every other currency. This is even as the US has seen heavy inflation and are facing similar price increases in energy, food, and materials. This is a global cost of living crisis, but many countries are feeling the pain worse than the US, particularly in Europe and developing nations. But why has the pound in particular fallen more than most, especially in just the last week? Last Friday, the UK government revealed its infamously titled mini-budget, a budget that was actually pretty massive in its implications. At 9:30am, Kwasi Kwarteng, the Chancellor of the Exchequer, stood up and began to reveal the budget. By 10am, the pound had fallen over 7% as global markets lost confidence in the UK's economic stability and leadership. The budget contained £45 billion in tax cuts and over £60 billion to fund the energy price support for businesses and households until 2022. Something needed to be done to provide people and businesses with relief from eye-watering energy costs. But a lot of analysts are pointing out the bulk of the cost will go to subsidizing the wealthiest segment of the population. That's not the only controversial part of the budget. Some of the tax cuts are going to completely eliminating the 45% rate of tax for top earners and lifting the cap on bankers' bonuses. People are understandably upset that the government is going to be taking out big loans to cover the cost of millionaires, while the average person's borrowing costs skyrocket, because that's going to be the result of all this increased borrowing. In fact, resulting increases in bond yields and potential interest rate hikes will make all this borrowing even more expensive to pay off. The Bank of England has stated that it will not hesitate to raise interest rates further to support the pound and combat inflation. And with the pound sinking to all-time lows, this looks highly likely to happen, and soon. And here is where the problem lies, and why the pound is having such a difficult time. People are simply losing faith in the UK economy, its levels of borrowing, and the leadership of the government. There are already rumours of letters of no confidence streaming in to oust Liz Truss, and there's a real possibility of her becoming the shortest serving British Prime Minister in all of history. A poll taken before the budget and consequential collapse of the pound indicated public discontent with the Conservatives and its leadership, putting Labour 12 points ahead. Even if you don't care about the politics of the UK, or even its economic stability, this is going to hit your wallet sooner than later. Most food and energy trade is done in dollars, and even if their costs stay flat on the global market, a decline in the pound means we all have to pay more for the same. This means further increases at the till for food and every other product relating to imports or energy. The ironic result in the budget's attempt to limit energy costs is that it will directly increase them through a weakening pound, meaning the proposed borrowing is likely to be much higher than stated to cover the cost, with some estimates seeing the future costs reaching over $100 billion. With borrowing costs going up, interest rates are forecast to more than double by next year, and that's without any emergency rises due to the current crisis in the pound. This could see the average mortgage raising from £800 per month to over £1,400 per month. And a lot of people are not going to be able to afford that, already struggling with the cost of rising energy and food. So, long story short, we're going to be seeing a lot more inflation over the next year. Previous economic estimates said we could reach 14% by April, but that was before the budget and decline in the pound. If there aren't some drastic rises in interest rates, I could see this easily topping 20%, which would be nearly halfway to reaching hyperinflation levels at 50%. This just demonstrates how quickly inflation can get out of hand with poor economic policy. The government and central bank are playing a risky balancing act right now. And to be honest, it could very easily go either way. In my opinion, one of the worst results is the most likely, and that's stagflation. Stagflation is where growth declines while inflation rises, and is usually the result of inflation through money printing combined with an overall economic recession where prices would normally drop but are kept high by a weak currency. So what does all this mean for the future of the UK? Are we at risk of defaulting on our debt and seeing borrowing costs skyrocket, or potentially even hyperinflation, joining the likes of Venezuela and Zimbabwe? For the most part, no. As bad as it is for an economic crisis like that to take place, there would have to be a serious spiral of externally held debt and repayment demands. Fortunately for the UK, we don't have a lot of foreign held debt, and most of our external liabilities are denominated in our own currency. While we could start seeing much higher inflation as a result of currency debasement and rising costs, there's a low chance of hyperinflation, thankfully. The Bank of England would step in long before this and would much rather plunge the economy into a heavy recession with sky-high interest rates than see inflation get out of control. What you do to prepare for these risks will be down to your unique situation, the amount of assets and cash you have, your income, and the outlook on what you think the government and the economy will do. Personally, I've had good success in keeping my own money invested, but in dollar holdings, not the pound. Even though some of my investments have declined in their dollar stock value, they've actually increased when valued in pounds due to the exchange rate alone. You'll have your own personal view, and if you're worried that inflation will run out of control, the last thing you want to do is hold on to the pound. But on the other hand, if you think the bank will put its foot down and go hard on tackling inflation with sharp interest rate rises, you aren't going to want to hold any UK-based assets for long. In the end, what this means is you want to pay close attention to what the government and banks do and say over the next few weeks, as it could make or break your financial future.